Welcome everyone to this episode of the AskJasonGelios show. I'm Jason Gelios, Michigan Realtor, and I appreciate you tuning in to this episode where I will be sharing with you 16 different types of mortgages. Now it sounds like a lot, right? Like, this episode is going to be 1 hour long, but it's really not. I'm going to cover what these mortgages are and maybe share a little bit about each one. However, I have them broken down into groups. And so let's go ahead and dive into this. So the first group is your fixed rate mortgages. And you probably already know about these. These are your most common, as I like to call them, vanilla mortgages, right? Your 30-year fixed mortgage, your 20-year fixed mortgage, and your 15-year mortgage. Now, I will note that years ago, and I don't know if it's available now, I've never heard of it, nor do I recommend it, but there was a 40-year fixed mortgage. I don't know, back in like just before the recession of 2008, they had a 40-year mortgage that I heard of. Not very popular. I'm not officially including that on my list because I don't think it's around anymore, but there was a 40-year fix. So you get these fixed rate mortgages, right? Your 30-year, your 20-year, your 15-year. Those are your most common. Now, we get into the adjustable rate mortgages, which you have a variable rate mortgage where the rate is variable. Then you have a hybrid arm where it's an adjustable rate mortgage, and it actually blends the characteristics of a fixed rate mortgage with an adjustable rate mortgage. So initially you have a fixed interest rate period, and then it's followed by an adjustable rate period. And then you have the option arm. Now, this isn't very common. However, the option arm or adjustable rate mortgage is an adjustable rate mortgage that allows you to choose among several payment options each month. So imagine each month getting a different payment option. And I believe it's, if you want to pay interest only for that month, let's say things are tight, you can do that, or you can make a full payment, or, so they should give you options per month. It's pretty cool, but you don't really see them a whole lot. Now, the next section that I have here is government-backed mortgages, and I've actually been a part of a lot of these as well, especially for first-time home buyers and actually veterans too, as well as people looking to purchase homes in the rural area. And I'm going to share with you why in a minute. So, okay, FHA loans, these are your most popular mortgages amongst first-time home buyers, although you don't have to be a first-time buyer to go FHA. It's a great option. Especially if you're trying to put as little of a down payment as possible. FHA is a great way to go. For veterans, you have the VA loan, which tends to come with a somewhat higher rate, not too bad compared to, let's say, a 30-year fixed mortgage. However, a VA loan, you don't have to put any money down, and there's many benefits to that, except there's higher closing costs. Okay, so these are I'm very familiar with these as well. So then you get into the USDA loans, which are similar to the VA loan and the FHA loan, but these are geared towards rural development. So USDA loans are there to spur growth and home sales in rural areas, right? Country areas where they don't get as much activity and as many buyers as, let's say, a busy suburban area, okay? Then you have another option, which is, state and local programs. And this really depends on what state you're in and what your area offers. In Michigan, we have something called the MISHDA loan, and they allow you to finance your down payment into your mortgage. And it's government backed. So lenders that offer this service of processing that MISHDA loan, they can basically help you out, and they have there's less risk involved because the government backs it. Okay. Now, here's some more. These are not government backed. These are some other types of mortgages. Now, interest only mortgage. Okay, this is something where you obtain an interest only mortgage where you have interest only payments. I believe it's 10 years, but there could be other options, but the most common that I'm aware of is the 10-year period is the first 10 years, is actually interest only payments. You're not paying down your principal at all, but then after that last interest only payment, your payment jumps big time. That's a great loan if you are someone, let's say an attorney. I had many attorneys go with this loan when I was in the mortgage industry on that side of things. Because lawyers, when they win a case, they get paid, so they would pay more towards the principal on top of just the interest only payment when they were able to, whether it was at the end of the year or whenever they won a case. So this was great for them. But I have known some people, not directly but indirectly, I've heard of people getting this interest only mortgage and then they become underwater in their mortgage. So you just got to be smart with it and don't just pay that interest only payment each month for the first initial period, right? Just knock it out. Actually pay more when you can, okay? A reverse mortgage, we've heard of this. Seniors, aging adults can basically tap into the equity in their home, and then the mortgage pays them per month. And I don't know if they do a lump sum, but I believe it's just per month. So a reverse mortgage does come with some criticism. Some people aren't for that, especially family members not thinking that the reverse mortgage is in their adult parents' best interest. Okay, but it is out there for people who want to stay in their home and they need additional money per month. Now you have something called a combination mortgage, and a combination mortgage is two separate loans granted by the same lender to the same borrower. This is good for if you're looking to fund the construction of a new home or purchase an existing property. Back in my mortgage days, we saw these things, we called them, or lenders called them 80-20 loans, right? Where you had 80% of your loan amount on one loan and then 20% of the rest, which allowed you to not, or to actually avoid providing a down payment. And you also got around the private mortgage insurance requirement. Then they had the 90-10, which was 90% and then 10%. But initially it's two loans for one property. It's not like a first mortgage and then a second mortgage that might be like a home equity line. It's actually the same mortgage. So let's say you're financing a home for $150,000. Okay, you would have 80% of it on one loan and then the 20% on another loan. You have two payments, and that's what that's how the lender sets it up. I believe they are still out there. They're not as common, but they were common back some odd years before the recession of 2008. So maybe that was saying something. However, you're paying principal. It's just you're going essentially zero down on a mortgage, and that's where if appreciation doesn't go higher, then that's I don't know. That's a whole nother conversation about the recession. Okay, so now you get into jumbo mortgages, and jumbo mortgages are your larger loan amounts that are geared towards more expensive houses, right? They're typically higher risk because you have less buyers that can afford or are interested in mansions, right? Larger homes and whatnot. So let me actually see if I can pull up. I should have pulled this up before, but I just want to show you because there's a minimum loan amount, okay? And we know that FHA has actually expanded how much they can actually lend out, which is pretty interesting. But okay, I don't actually have that. Plus, it changes up. It will change again. But in essence, if you're going with a larger home that is a larger mortgage, okay, you would go with a jumbo mortgage. All right, so now let's go into actually the balloon mortgage. And many people don't like the balloon mortgages. They get scared, right? They don't get excited about the word balloon. It's not like it's at a kid's party and they see a balloon, okay? This is a balloon where basically you have a mortgage that balloons into a full payment after a specific time. It scares many people, right? It just does. That payment is attractive at first, and if you're not, as you get extra money or able to pay put extra money towards principal, then you get that adjusted payment after a certain amount of time, and next thing you know, it scares you and you have to do something, right? And then many times, a homeowner can't make that payment because they get so comfortable with the lower attractive payment. So that's a balloon mortgage I just mentioned. And then the last one is actually a second mortgage. So we think about, or I reference, your home equity line of credit, which is actually a home equity line of credit, a HELOC, a home equity installment loan, which is just a set lump sum that you get from the equity in your home. These things fall under the second mortgage. There's some other types of home equity, but in a nutshell, the second mortgage is another mortgage. So you can have a first mortgage on your property, and you could do a second mortgage and do a home equity line where you're accessing the equity in your home. And it could be like a credit card where you just take what you need over a specific amount of time, or you just take out another loan and you get money, and then you make that payment each month. So that's a second mortgage. So 16 different types of mortgages. I hope you found this helpful. Have you applied, or do you currently have any of these mortgages? I'd love to see your comments and your thoughts in the comments actually about what you thought about it. Have you done a balloon mortgage? Have you done an interest-only mortgage? Share your thoughts in the comments. Otherwise, I appreciate you watching. I'm Jason Gelios, Michigan Realtor, and I'll talk to you next time.